Well, welcome to the course. In the first video, we're gonna to be talking about which are the things you're going to learn. Okay. So basically, we're going to go into a very deep dive into the markets and especially on smart money techniques. Okay. So it's gonna be kind of long, but also very informative. So I recommend you to put a lot of attention, take a lot of notes, and get ready to learn. Okay, so let's go into the topics we're going to be learning. Okay, so then we can start learning about them. Okay, the course is going to be about 22 topics. Okay, all of them are going to be very important, so I recommend you to watch every single one of them, and if you do not understand, to watch them multiple times. Okay, I recommend you to watch them multiple times and take notes. If you do not understand one concept, do not skip to the next topic unless you understand it completely. Okay, so let's go. Number one, we're going to be talking about market structure, and this one's going to be a really important one. Okay, market structure is very important, but also you have to use it in context. Okay, we have to use market structure in context with order flow, which is going to be one topic we're going to be talking about as well, and also with the higher time frame market structure. Okay, later we're going to be talking about trends, okay, and changes in trends, which is related to market structure. Okay, after that one, we're going to be talking about market profiles, which is going to be basically knowing when we're going to be likely going to be in a profile which is not going to be that important market structure, and liquidity is going to be more something into taking into consideration, and we can apply different trading models. Okay, later on we're going to be talking about fair value gaps, which are inefficiencies in the market. Okay, we're also going to be learning about BPR, which stands for balanced price range. Okay, which is another kind of inefficiency, and also it's a kind of change in delivery state. Okay, change in the trend, like a market structure shift. Then we're going to be talking about inverse fair value gaps. Then we're going to be talking about CB and BC, which is one kind of fair value gap, which is just another inefficiency which is bigger than a regular fair value gap, and there's some certain rules that we want to see CBs and BCs respect. Okay, then we're also going to be talking about inverse volume balance. Okay, inverse volume imbalance, and also of course volume imbalances. Later on we're going to be talking about the blocks, which are order block, okay, breaker block, rejection block, mitigation block, inverse order block. Okay, all of these topics we're going to be talking about them on detail. Okay, so no need to worry. We're going to be discussing what makes one high probability order block, breaker block, rejection block, etc., etc. Okay, no needs to worry. We can also be talking about propulsion blocks. Okay, propulsion blocks are another kind of order blocks. Okay, which have some details like every single one of them. Okay, so every single one of them has their own characteristics and specifications that we want to see them respect in the price. And lastly, but not least important, if not one of the most important topics we're going to be talking about, are the kill zones, which is Asia, London, New York, and London kill zone. Okay, also London close, which is also an important one in some circumstances, okay? Lastly, we're going to be discussing what is liquidity, why is it important, where can we spot liquidity, and the different kind of liquidity, which obviously is internal liquidity and external liquidity. Okay? Also, we're going to be talking about central bank dealing range and how is it likely for us to find the daily high and the low of the day. Okay? Also, we're going to be talking about relative strength analysis, which will help us define and determine which is the preferable pair we want to trade in dependent circumstances. If we want to short, if we want to long, which is the weaker or which is the stronger pair, okay? Also, we're going to be talking about SIG pair and the leading pair, which is also a very important topic. SMT divergence, which will help us determine if there's a smart money accumulation on the markets or if there's some kind of smart money trap. Also, we will be talking about relative rebalance, okay? Also, we will be talking immediate rebalance. And lastly, for the concepts, we will be talking about MMXM, which stands for market maker sell or buy model, okay? And for last, which is not a topic about the concepts itself, if not, it's more about, like the name, psychology. It's going to be a class about psychology and which book I recommend you to study, okay? I recommend you to study a book. I also recommend you how to think, what exercises you can do, and so you can develop a correct mindset for your trading, which is one of the most important things that you need, because the analysis, you can learn it in a few months, maybe even if you want to learn more deeply, it could take about 1 year, okay? 1 year to learn, to understand the markets very deeply. But if you do not have the correct mindset and the right psychology, what are you going to do with all this knowledge if you do not know when to apply it, how to behave, and everything, okay? So the analysis is very important, but also we want to think like a professional, okay? So this was it for this video, and we will be going immediately to the topics, okay? So welcome, and I hope you have a very nice day. Okay, well, on this class we're gonna learn about market structure, okay? So let's go to a daily time frame. Well, let's actually go to a weekly time frame. And let's go over here. Market structure is basically swing high and swing lows formations and the legs of this swing low and swing high formation. First, let's define what's a swing low and what's a swing high, okay? A swing low is one candle that has a lower low and two higher lows to its right, okay? So this is higher low, lower low, because we can see the candle is over here, and higher low, okay? This is a swing low. And later we have what we call a swing high, okay? This is a swing high. Lower high, higher high, okay? This is a swing high, this is a swing low, okay? So in this case we have our market structure from here to here, okay? Once the market structure is broken to the downside right here, we change our trend. In this case, the trend was bullish, and in this case, the trend is now bearish, because this is a swing low that made a swing high. Okay? And then we ask ourselves, okay, where's the swing low after a market structure break, and where's the swing high? In this case, this is our swing low, and this is our swing high. Okay? That's our swing high, this is our swing low. And as soon as we break again and mark a new swing low, this is our new market structure. Okay? Our new market structure is this one right here. This is our dealing range. Once price breaks through it, and now this is our market structure. Okay, this is our market structure. This one right here. And we break through it again. We mark a swing low, then we have our swing high that made the swing low. This is our market structure. Okay? In this case, we do it again, and we have a new market structure. Swing low, swing high. We break through it again. Swing low. Where's our swing high? Well, this is our swing high. That made the swing low. We break through it. Now we change our market structure, and we can use whatever of these three swing lows. In my case, I would use this one because this is the swing low that made a real expansion upward. And this is our swing high. Okay, we break through it again. Perfect. Swing high. I'm gonna use this swing low again because you can see this is a swing low. However, I'm going to use this because this is the real leg expansion. We break through it again. This is our swing high. This is our swing low. Right now we're breaking through it, okay? And this is market structure. Now we can assume that it's likely for this to form a swing low. We're gonna have some kind of retracement in the next few weeks, and then we can continue lower, okay, to get these swing lows over here, and maybe even these ones. Or I don't want to touch this topic right now, or we could just be a ranging market in which, as you can see, this was our ranging market. Swing high, swing high, swing high. We go down into the ranging market again, okay? And this was just a deviation of the ranging market, okay? We have a deviation of the range. We go back inside the range, and we go down. We could assume this could be one of those scenarios in which we take the bottom of the range. We are right now not showing signs of displacement downwards, so we could assume this could be a deviation, and we go up again. However, we cannot tell until we can see on a different time frame the same market structure. For example, right here we had this right here that was our range highs. We deviate from the market structure. We show unwillingness to continue higher because right here the structure was bullish. However, we are not respecting anything of the bullish arrays, okay, that we're gonna touch later on this course, so no need to worry. But we're not respecting any of them, so we can assume that it could just be a deviation of the range. We go back inside the range, and what's likely to go? Well, all this, and this, which already happened. Now it's time to figure out if we're going to deviate and go higher, or just do a retracement on a higher time frame like a weekly to continue lower. Okay, so that's pretty much everything about market structure. We're just going to do a quick review on the daily time frame so there's no doubts. Okay, on my opinion, we're likely to go higher, but we're only going higher for a retracement. And you're asking yourself, okay, we haven't broken the market structure on the daily. Okay, it's something that I'm going to teach later on in this course, so there's no need to worry. But we do not always need market structure in case to determine when it's a change of the trend, because we could just say, okay, we took all this liquidity of the marketplace and we're likely to retrace to a premium, trap people that only look for market structure, and then we resume lower. Okay, because on this case we could see it right here. Let's say you were one of these people trying to short all the way. Well, this was just a retracement on the weekly and we went up again. However, the market structure on this was bearish. Why? Look at this. We have this swing low that made swing high, right? We break through it, we change the trend, and also we go outside of this range. So we're determining to go lower. Okay, you could get trades for a whole few of days because the market structure is bearish. However, you need to determine that your higher time frame is still bullish. So we have a bullish market structure because our swing low is all the way here to our swing high all the way here, and we're just doing a retracement into a discount zone for later on continuing higher. So that's just me clarifying that you need to have context on the marketplace and not just think market structure is it. But do not worry, I'm going to talk about this later on. So I'll see you guys on the next video and talk to you later. Well, after we discuss what is market structure, we can identify what's a trend. Okay, what's a trend, you're asking yourself? A trend is basically market structure and also the order flow. And what's the order flow, you're asking yourself? Okay, order flow is how is the premium and discount arrays, which we're going to discuss later on, being respected, and how is price delivering? Is it delivering to a buy stop or to a sell stop? Is it delivering to liquidity on the upside, or is it delivering to liquidity on the downside? Because let's just get this straight up. The marketplace only moves from liquidity to liquidity. Okay, the marketplace do not move from randomness or for buying and selling pressure. Okay, the market does not move that way. The market moves because of the liquidity. Okay, if not, why does the market continue time after time to repeat the same things? It's not moving that way because there's at certain places enough or less sellers. It's impossible. The probabilities of that being true are absolutely zero. Okay, there's no way that the market is just going to move to a certain place because there's going to be buyers here and then buyers buy here and it moves. Okay, it's not true. That's not how the market moves. Okay, the market does not move because of a buyer or a seller. What is the truth? It's the market moves from liquidity, where in the liquidity there's going to be certain buyers and certain sellers, which are not you, not me, not 99% of the people. If not, they're hedge funds, they're institutions, they're banks, which need the liquidity on the marketplace to enter. Okay, they need to move the market all the way here so they can enter the positions. They cannot enter their positions, and let's say for example they want to sell short, they cannot just sell short over here. They need to sell short above where the market believes it's a price where price shouldn't go higher, And people also think once it breaks through there, it's going to go much higher. They need all the liquidity available on the marketplace. Okay? So they will go to places where there's liquidity resting over here, and then after that they will make a change in the marketplace. Okay? Only after they take the liquidity of swing highs or swing lows, it's that they can do their entries. Okay? That's how the market delivers. With that being said, let's just discuss something really quickly. We already know what's market structure. Remember, if you do not understand one topic, you can just go and watch the video multiple times. There's no need to rush. But what's a trend? A trend is basically when there's a swing low or a swing high and order flow is being respected. In this case, we broke here. We're making lower lows, higher lows, lower highs, my bad. We're making lower lows, lower highs. And when does it change? Right here. This is a premium place in the market. Okay, this is a premium marketplace, and this is the swing high. We're going to discuss later on why this is a premium. Do not worry. As you can see, this is making the market unavailable to go higher. As soon as we see this candle close above, we can determine this swing high is the next round liquidity. Okay, this swing high is gonna be the next round liquidity, and we do not even need to wait for the market structure to break. But let's say you're not that advanced right now and you're saying, what the hell is he saying? I do not understand. Don't worry, we're going to go later on into this. But this is the next round liquidity, such as here. We haven't broke this swing high. This is the current market, as you can see right here on the right corner. And we haven't even yet broken the swing high. The market structure is bearish, but is the order flow being respected? No, no, no. So there's a change in the trend. There's not even a need for me to get to need to wait for the market structure to break. The market structure only shows me where is the liquidity resting and where it's probable that the market may go to a turning point. But as soon as I see the order flow not being respected, there's a change in the delivery state of the marketplace, because the order flow is the #1 factor. It's not the market structure, okay? But let's go. In this case, we disrespected bearish premium because this is premium, and we can determine swing high is going to go. Then we have this on the marketplace, which is being quite respected. If we are honest, the price is being kept right here. And as you can see, there's a swing low, there's a swing high. You could say, okay, we just changed trend. No. Why no? Because there's still liquidity resting over here. And this is just entities accumulating their buys. Every time it goes below a swing low, what does the market do? Immediately gets bought up. We get down below again, immediately gets bought up. But something to take notice is the bearish arrays are being respected, so we're short-term bearish. Okay, we're short-term bearish, but in our heads we need to determine this is the drawn liquidity, and the higher probability trades are always going to be on the side of the longs. So once we see this, this is a breaking structure and also a change in the delivery, because this is not being respected. As soon as we see this, we can determine the next day, which is a Monday, as I believe it's going to happen next week. The next day, which is a Monday, it just goes ballistic. Boom, 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 boom. Liquidity target. We distribute all the buys over here and turning the marketplace. Then we have a change in the trend. Why? Because if we are saying this is where the market should stop, which it does for a while. But then we see this, boom. Now this is going to be the resistance, because this is algorithmic principles. Okay, this is going to be resistance on the marketplace. And as you can see, every time we touch it, it's resistance. And when it's also going to be resistant, right here. What's the number here? 82. 75, almost touched it. Right here we touch it, we close below. What's here? It's swing high. Swing high as well, swing high as well, swing high. Boom. We go lower. Why are we targeting, why are we looking at swing highs? Because the swing highs are going to be resting buy or sell orders of people thinking, okay, as soon as it goes above the swing high, it's gonna go higher. I mean, it does go higher, but it stops and then goes lower and you lose. Okay, same thing here. It does go higher, but then it closes and nukes. Okay, the order flow is being respected on the bearish. Okay, that's pretty much everything about this, and let's just go to the next topic. Okay, well, this class we're gonna be talking about, let's go to a clean chart so that we do not touch any of my annotations. Okay, basically a fair value gap. We're going to be talking about a fair value gap. Okay, what is a fair value gap? A fair value gap, it's a form of liquidity, okay, and also a form of premium or discount in the marketplace if we're seeing it correctly in the form of market like order flow. So it's simple, okay? If we see it like order flow, it's also a type of premium and discount, but especially I like to see it more like a liquidity and also order flow, okay? But I like more order blocks in this case for order flow that we're going to be talking about later on. But a fair value gap, it's also a form of order flow, okay? And liquidity. What is a fair value gap? A fair value gap is basically the intersection between a three candle, okay? It's a three candle pattern. 1, 2, and 3. Is there any blank space in between them? Of course, all of this inefficiency in the marketplace. On the weekly time frame, you could not get any selling at these prices between 140.8 and 145.7. Okay, between these prices there was no selling if you are institutions trading in the 1 weekly time frame. Okay, so it's also a form of liquidity because if you can see it, it's the high of this candle. How is it going to look on a daily time frame? On a daily time frame, it's going to look as the same as a liquidity. However, this was not taking, okay? On the daily time frame, we never took this fair value gap. We never took this inefficiency on the marketplace. As you can see, the place right here, it accumulates, it balances this price, it offers sellers, then it goes lower, it takes a swing low, which is a part of liquidity, and most likely it's going to be a fair value gap on the monthly time frame. As you can see, it's a fair value gap on the monthly time frame, which we do not offer any kind of buying opportunities on a monthly time frame. And on the weekly, it's most likely a form of inefficiency as well, which is another weekly fair value gap. Okay, so we can see the price is holding this inefficiency on the monthly and on the weekly, and it's respecting the order flow. Okay, right here we would want to see the price respected this one, so we will be kind of doubting if it's truly on the weekly time frame a change in the delivery because we didn't respect this one, neither these order blocks, and are we going to trade lower. But if we always go to our higher time frame, where is the most liquidity pending? Right here. Here is the liquidity. As you can see, same thing happened here. We went for the liquidity, then we went lower. Okay, We went lower where? To a swing low. We took the liquidity of the swing low and we accumulated on this fair value gap. And then we went higher. Okay, now what it's likely to do? Well, it's likely to reach this liquidity, and then we can talk about, could we even go over here to this liquidity, or are we going to change the delivery state once we get here? I do not know if we're going to go to 160. I am not a wizard, but I can certainly tell that we want to see the order flow. On this time frame, the daily, are we respecting the order flow? Where is a fair value gap? We have no fair value gaps here, 0. But we have one fair value gap here. Is the price being kept inside of it? Is it being respected? Of course it is. And we also have a swing low, which was taking the liquidity, and then we're trying to go higher. The only thing that we should be cautious right here is this fair value gap. Because why? You're asking yourself. Well, first of all, the order flow is still bullish, okay? There's no doubt for me. But this is a big displacement candle. Big displacement. So if we get to see price touch this fair value gap, which is a form of liquidity because it's most likely a swing high on the daily time frame, as you can see, it's a swing high. Well, if we're starting to respect the bearish order flow and we touch this and then we break a swing low and we are not respecting this fair value gap anymore and we start trading below it, then this is going to become, I'm not going to say it right now because it's going to be a next topic, but this is going to become a premium now, because we're likely to go where? To get this liquidity over here, this right here. We're likely to go get all this liquidity, and if we look to a weekly time frame, where could we go? Where could we go on a monthly or a weekly? Where is it likely? Well, on a monthly there's no any left, and we shouldn't go over here. If we're bullish, price shouldn't go over here. On the weekly, where could we go if we're actually bullish? Well, on the weekly, we already touched a premium and discount, which in this case is a discount, and it's this one right here. Okay, so we are supposed to trend from here and get this. If we are stalling over here and we disrespect this fair value gap, which I already explained, 1, 2, and 3, we're likely to go lower because the liquidity is already been taken. As you can see, liquidity taken. Also, it's a form of premium. In this case, sellers are going to be stepping up here and we're likely to go lower. However, if we start trending above this candle, okay, if we start trending above it, we're likely to what? To reach all these highs. So it would look something like this. It would look like this. We took the liquidity, we touch a discount on the weekly time frame. We would like to see a candle go this way, then a candle go this way, and later on go like this, touch another discount, will be over here, because we will think that in this candle that went lower, they were actually buying. So this candle is going to offer us support, and after that we should take the liquidity. Okay, but that's just me trying to explain topics that we're going to look later on. As you can see, we have a fair value gap here. We traded lower to it with rally. What can we see over here? There's also a small fair value gap. Price trades over here. We accumulate, we respect it, we take a swing low before rallying, which is what most of the times happen. Boom. We mark a fair value gap as well, which is over here. The price is respecting the fair value gap. We go higher. And right now it's doing the exact same thing. So it's not weird to think that we're going to go higher. Okay, it's what we've been seeing here. This is just a manipulation before a continued rally. Okay, however, if this is lost, we would likely see price go lower and gravitate to take all of this, and we could even argue that it's likely to see a local top. Okay, because price should not really, before taking the liquidity, if we want to, it should not start retracing all the way here, because in this case we're disrespecting the discount and we're starting to respect the premium. And where is it likely to go? Well, for here. And on a monthly chart, it's going to look like a change of delivery, okay? Because it would disrespect most likely this fair value gap and also take this swing low, go here and go lower. But in my opinion, it's just no point in predicting. The best thing is to think, okay, this fair value gap is just going to offer us support, and if this one right here starts making price go lower, well, same thing. Well, on this class we're going to be talking about a really important topic, okay? And let's just go to a chart that actually I trade, which is euro dollar or GBP dollar, okay? This is called volume imbalance. Okay, volume imbalance. It's the same as an imbalance in the sense of how do you use it, but it's different. It's also a premium or discount place in the market. This is a volume imbalance. As you can see, price stayed here during this week, and then the next week opened and it went lower here. Okay, it went all the way here. Boom, out of nowhere it opened here. So there was no way, like 100% no way that you could have shorted here, 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 here once the week opened. Okay, only until it traded all the way here, it's that you could. However, this was not on a weekly basis, filled with volume, not wicks, volume. Okay, as you can see, we went over here, which we never touched, neither here, neither here. Then we touch it, we distribute with volume, and then we go lower. Okay, I'm going to show you plenty of examples. And how you use this is you can expect the market to have a turning point here for a few weeks. Obviously, it's not going to mark the bottom or the top of a market, but it will offer a few days or weeks depending on the time frame, because you can also find this on the daily time frame. It depends how much time it might give. As you can see, this one accumulates, goes higher, but later on it goes lower. Okay, but as soon as we see this accumulation and displacement, we can assume that there's going to be a lot of weeks, because these are almost 1 or 2 years of trading in which we could get opportunities. Okay, let's go into more examples which we can find without any problem. If not, we can go to GBP chart. Okay, because I believe on the weekly time frame there's no much left to see over here, except for maybe if we go to the daily time frame, and I can show it to you. We have this volume imbalance on the daily, which we come here, we accumulate, we go higher. Okay, that's a volume imbalance on the daily. I don't know if there's more on euro. Okay, I believe there's no more than I can recall on my trading, but it's a phenomenon that we can find in many charts, not just in euro. We can find it on GBP on DXY, which DXY will offer us more of this phenomenon. Okay, it will offer us plenty more examples. As you can see, this is the volume imbalance which gets traded through, then it gets retraded. We go lower, we touch it again, there's a fair value gap as well, we go higher. Okay, there's also one over here. The price goes through it. We do not need to wait for this to be broken. As soon as it gets traded through it, we can assume premium arrays are not getting respected and we're likely to go higher. Then we have this volume imbalance over here, which the market touches, and as it's a premium, it will most likely retrace where? To a discount, which is this fair value gap, which I already thought on the previous lesson. We touch it, we go lower. Once it's traded through it, this will offer us support, but we will see this on later classes. Also, we have the support and the fair value gap support, which is this one right here. As you can see, we trade the fair value gap, we go higher. Okay, we can see that right there. We also can see it right here. We trade, okay, it gets disrespected. In case the marketplace at some point gets here, we're expecting the price to get a little retracement at least, because it's a premium on the marketplace and it will want to displace to a discount. Same that happened over here. Volume imbalance, touch it, we take stops. There was stop losses over here at this swing high, the swing low. We take the stop losses, we touch a premium, then the market goes lower. And I mean, I think the concept is understood. I could show infinite examples on different pairs, different markets. There's no use, but I can show you, as you can see here, GBP, where I'm saying that I'm bullish on the market. Why am I bullish? I'm seeing where is this origin from a volume imbalance. It's getting originated, this movement, from a volume imbalance. So I'm bullish, and I'm thinking we're likely to go all the way here, but at least this stops goes, on my opinion, on Monday. We trade through it, and then we can see market go here on a weekly time frame. We could even retrace higher. I do not know, I do not control the markets, but we could retrace over here maybe to this fair value gap, and then we can talk about taking all these stop losses, and then we can think, okay, we took the stop losses, we're likely to go the opposite side, or we could just stay here, leave this liquidity for a later time, and then we take it. But the monthly time frame, it's bearish. Why is it bearish? We touched a fair value gap that were explained, and we're disrespecting the bullish premium and discount arrays. We traded through it, and where is it likely to retrade to? This monthly fair value gap, where it's all of these stop losses. Okay, but that's not the topic of today's. Okay, just explaining and showing to you. Okay, so that's a volume imbalance. We also have a volume imbalance, if I remember correctly. We had a volume imbalance right here that hasn't been traded through it right now, actually. So this will be referenced later on to the marketplace. If the price gets over here, we took the stop losses, we touched the volume imbalance, we can expect the market to go lower. Okay. As you can see, we get to the volume imbalance, and the price retraces, trades through it, retraces, now it's resistance again, goes lower, lower. Finally, we take all the stop losses, which are over here, and then we have a reversal on the marketplace. We take the stop losses again over here, and then we have a reversal in the marketplace. That's how the market moves, liquidity. And there was the GBP crash, if I don't misrecall. You can see over here the volume imbalance. When it gets traded again, it offers the price resistance to go lower. Okay, next, the last example will be Bitcoin. Okay, so you see that it's basically the same on every single concept, and it's all algorithmic. Okay, volume imbalance, we go to the volume imbalance, we go higher. Okay, volume imbalance, we go higher. Now it's serving as resistance. As well, we have a swing high over here, which is likely for price to go take these stop losses. In my opinion, I could be wrong, but in my opinion, it's likely to go for these stop losses, unless we go straight through it, and then we can talk that we're likely to go for this one right here and have a retracement later on. Okay, but it's basically the same thing. Price will want to trace again to go lower. Same thing here. Price, where does it stop? It stops right at the volume imbalance. It's not random, as you can see. It's not random. Price stops here, goes retrace, then it goes lower. And where was the Bitcoin local bottom for a while? Well, the local bottom for a while was over here, right? This volume imbalance at the price reference as a now premium, it goes lower. Okay, after we take all these stop losses, we go higher. It's the same on all the markets, because that's how the institutions enter the marketplace. Okay, and Ethereum, as you can see on Ethereum, it's pretty much the same thing. Volume imbalance, higher. Where is the volume imbalance? Now it's inversed. So now this is our resistance, and where we're likely to drop. In my opinion, we're likely to go all the way here, and maybe even all the way here, because we still have liquidity from these lows over here. So it wouldn't be any surprising if we go here at least, and maybe even here. But that's not the class of today. Today is not only for you to learn what is a volume imbalance and how is it and how does it work. That's it, nothing else. Volume imbalances, you can use them as your support and resistance look for a lower time frame entry. Okay, of course you could trade the 1 day with this, but you're going to have a better risk to reward if you trade it with a daily on lower time frame entries, because you have the same price that I already thought on these lower time frames. You can use it to get confirmation of your entries. Okay, that's pretty much it. So I hope you liked the class, and I'll see you in the next one. Well, in today's class we're going to talk about what's a BPR, which stands for balanced price ranged. Okay, BPR. Pretty much a BPR is, you know, when price has a huge imbalance. Okay, okay? Huge imbalance. For example, well, it doesn't need to actually be huge, you know, like, I'm just trying to make you understand. But let's say, for example, let's get an easy example. We have an imbalance, a fair value gap, balance fair value gap, the same thing, okay? And price trades through it with strength, okay? Like, boom, huge, huge candle, okay? We want to see that price now respected and used as our support or resistance, depending on whatever the market's doing. Let's go to a chart like Nasdaq, okay? Let's go here so I can show it to you. For example, we have this right here, this price action. And let's look for a one imbalance, okay? Okay. We have this imbalance right here, but it's not actually a BPR. Here we go. This is a BPR. Right here. Perfect. We have this imbalance and this imbalance, and then it creates another imbalance. Which one? This one and this one. This. So the liquidity was offered right here, and then it was offered right here. What is the protocol for a BPR? We do not want to see the price trade through 50% of it, okay? If we see price trade 50% of the balanced price range, that is BPR, it immediately switches to the opposite side that it's trading through, which in this case will be bullish. So as soon as it trades 50 right here, we can determine it's bullish. This is a failed BPR, okay? So you understand and we get it clear from now. Let's look for a real BPR, okay? A BPR that we can actually use. We have this candle, perfect. You can see here and here, okay? And then we create an imbalance. We do not want to see the BPR 50%. As you can see, 50% is right here. Price goes lower, okay? Price starts accumulating inside. All the time the algorithm is referencing as premium. It's going lower, 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 lower. You can sell, you're winning money all those days. Selling, 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 selling. This is a daily chart. You're selling, selling, winning, 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 winning. Boom. Right now, your BPR is now bullish. Now you have a bullish bias. As soon as you see this candle. As soon. Right there, bullish. You don't even need to wait for this swing high. And actually, the price is just showing higher highs and higher lows. As soon as you see this, what are you looking for? 50% of that BPR. Now you can inverse it. 50% respected. We do not see a candle body cross through 50%, which is super. Next candle we see this. Boom. All these days, if you had this bias, you were winning. Until when? Until the same exact thing happens. Here, is it a balanced price range? Not really, because as you can see, this candle does not trade through it. Okay, there's no BPR here, so there's no balanced price range. Okay, but where do we have one? Right here. Right here we have a BPR. However, I don't know if this is the one that we used already, but this BPR is not respected. It's traded through. And we took stop losses. Boom. We end up going lower. Okay? But where? To take this swing low. We take the swing low. We take this again. we go higher, and then we just rally like crazy. Okay? But let's look for more so you can understand this better. Right here, perfect. This will be your BPR. Price does not trade through it or nothing, okay? Like, price doesn't touch it. And the next candle, boom, destruction. Immediate destruction. Where's your BPR? This right here. We do not want to see the 50% closed. The wicks can touch it. Okay, if they can touch it, there's no problem. Because they're just accumulating on the wicks. They're selling, and then it closes below. But as you see, it touches, it goes lower. Where could we see another one? Let's look for more. This happens since all the time. Okay. This one, does it get traded? Yep, in this candle. So no, it doesn't count. Nope. Nope. But we can get more on the 1 hour time frame. Okay, so do not worry. This is more for a lower time frame thing. Where is a BPR? As you can see, this is a ranging market, so it's not going to be that easy to find a BPR because there's no clear trend. It's just liquidity. With liquidity, we go down. We take liquidity, we go down. We take liquidity, we go up. This is a range. But if we go over here, where is a BPR? We're likely to see one over here, which would be this one. Yeah, I think I remember. Right here. Okay? You see right here, this would be a BPR. Because it's traded through it. It touches the BPR, it goes lower immediately. Touches, lower. Okay? Then it gets traded through it, so we have a change in delivery. We don't even need to wait for this to be broken. We don't need to wait for this swing high. We already get traded through it. We're just bullish at this point. On this candle, we do not even need to wait here. 10 a.m., we're looking for longs. Immediately. And there's actually a BPR right there. There was a lower BPR that was getting disrespected right here. So this would be actually your trigger. As soon as you see this candle get traded through it, you expect this to get traded. Because you have a BPR and it's getting disrespected. Respected, 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 disrespected. Boom. Okay? Quite simple, actually. What else can we find? I'm just going to show one last example, and then we're done. Okay? This one, perfect. We have this BPR. Well, actually no, now that I was gonna mark this one, but this candle gets straight through it. So, nope, no BPR. As you can see, it's quite of a ranging market on Nasdaq right now. I actually do not trade Nasdaq, but as you can see, it's a range. All of this is just a range. It's not trending like over here. It's ranging, going down, going up, going down, going up. But we could find, without a doubt, one last example for you to know and understand better. Right here, perfect. Last example. We have imbalance, which is literally go ballistic through it. Boom. we leave a huge imbalance. Am I just going to wait for this swing high to be broken and for price to rally then? Am I really going to? Or does it have a confluence in which there was stop losses over here? 1, 2, 3 stop losses. These are probably daily lows, and there's likely a fair value gap over here. We touch the fair value gap on the daily, then we leave a lower time frame BPR, which price touches perfectly. It never disrespects it, and we don't need to wait for the swing high to be broken over here. We could just literally see this. Okay, BPR, we think market's bullish now. We took stop losses. I'm looking for an entry over here. You could enter here, right here, as soon as it touches the BPR, right there. Where would your stop loss be? It will be over here. Where would your target be in this case? Of course, the liquidity highs, which eventually gets tapped. And yeah, the market just continues to rally. But you do not know this. You do not know market's going to do this. You know, you do not know unless you're looking for a swing trade. Like unless you're looking for weekly time frame and you want to catch a 41 risk reward trade, that if you do that, you can just stop trading for the rest of the year. But I mean, it's just insane risk to reward. But pretty much I think I'm correct on this. There was an imbalance, like I don't even need to watch the daily to know it. There was an imbalance, there was stop losses there, and we just manipulate, we create a PPR, we change delivery, and where are we going? Well, for these highs, because we're trending up, we're just manipulating on this case. But I'm obviously not going to know this is going to happen. My trade was going to end here for a 5.5 risk reward, which is pretty good. Pretty good, and more if it happens in 2 days. 1, 2. Next day, trade done. What are you doing now? You're looking for another trade. Where? Right here. You're looking for another trade. Well, where am I entering at? I'm entering at this fair value gap when I get a lower time from displacement. Okay. So that's pretty much it. And let's go to the next class. Well, today we're going to be talking about inverse fair value gaps. We already know what's a fair value gap and everything. But what's an inverse fair value gap? Inverse value gap is pretty much once the market gets traded through a level and changes the delivery state, the fair value gap is going to be used as inverse. For example, we have this fair value gap that is being used to pretty much trade and sustain the price. Okay, it's getting used. We're taking also the buy stops, like we're also taking all these stops. We're taking stops, and boom, we get a candle that closes below it. Okay, also if you notice, we haven't broken actually this, okay, here, but this one breaks it. But what does it do first? It touches the fair value gap again and goes lower. So it's an inverse fair value gap. Then we have this one right here, which gets used to this place lower. On this one, we do not have any fair value gap, right? That's what you're asking yourself. What if I say to you that we actually have this fair value gap now? And that we do not want to see the price go higher than here, because the only place it could actually go, if there is any, it will be this fair value gap. So we just want to see the price wick through it and close here. Okay. Once the price trades there, using this fair value gap, what is the next zone that we can inverse? This one right here. There's no fair value gaps over here. There's only right here. Okay. There's only a fair value gap right there. We go straight and go lower. What are we going to use now? We're going to use this one. This is what inverse, because there's no fair value gap here. I believe there's a small one right here, which gets traded right here and lower. But we will want to see the price sustain over here. Where if we were bullish, we will obviously not be looking at this. We'll be looking at the volume imbalance to resist, okay? Which was the correct perspective for long term. But in the midterm, we could be also looking for sells or an invalidation. And which one will be our invalidation? Right here. Once the price trades through the fair value gap and uses it as support. Now this is our inverse fair value gap. Now we're bullish again. What places are we looking? What places? We're looking at this fair value gap, okay? Correct. Is there any fair value gap as well? No. No, none. There's no fair value gap there. So you cannot use any because there's no any. But we can use other Peter arrays that we're going to discuss later on. For this bearish, is there any? Yep. As soon as we change here, because this is not a fair value gap, we're going to be talking about this later on the class, okay? Don't worry. But as soon as we see this, we use this as an inverse one, okay? If you want to be more secure, you can wait for it to be traded through. Is there any fair value gap here? There's no fair value gap, but there's an inverse one. And we don't want to see this inverse fair value gap get traded through. So we're just looking for shorts every time we tap it. Short, 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 short. Now, what are we looking at? We're trading lower, okay? Where are we looking? This inverse. Is there any fair value gap here? There's none. There's no fair value gaps. Zero. Zero fair value gaps. There's no here, there's no here, there's no here, no fair value gaps. But there's one here, there's an inverse one. We use this zone now as our true resistance, and we do not want to see the price get traded through here, closing basis, and start going higher. We want to see price close inside or below it, like here. If it's closing inside, it's okay. It's okay. No need to panic. As soon as it closes above, now you don't need to panic, obviously. I'm just like talking. But as soon as you see it, you're calm. You say, okay, my idea was wrong. Where are we likely to go? We're going for these highs, so I'm just gonna get early of the trade. But it never does it. Correct? It never does it. Now we boom, trade through it. There's fair value gaps here. Yeah, there's fair value gaps. We go lower, lower, lower. Is there any inverse ones? No, really. However, we can count this as a fair value gap. Why? You're asking yourself. Because the wick and this, if they intersect, we measure the one that went up and closed below, and the low. That's a fair value gap. Because the real volume of the candle, it's at the volume, the body, not just the wick. Okay? Once we trade it through it, there's also a fair value gap here, so double confluence, there's a fair value gap there, which price accumulates, but also we have this inverse one, which we do not want to see neither of the two go past, because if we go past it, of course, we're likely to say, okay, we took the stop losses over here, we're likely to go higher. But we never do it. We can just sell. Okay. Remember, these topics, you're maybe going to need to watch it 1, 2, 5, 10 times until you understand it. I'm not going to teach this right now, the inverse volume imbalance, but it's pretty much the same thing. Okay. Is there any fair value gaps left? Nope, there's no inefficiencies in the marketplace. The only inefficiencies that we could probably be seeing are these ones right here. Inefficiency, inefficiency. However, all the marketplace right now, it's without any inefficiency to the downside, except for these ones, which will likely be reached later on. Okay? Now, we had this fair value gap, which price did not respect, and it's closing above it. It's likely to go for the stop losses, so that's why I'm bullish for the next week. Also because we do not have any retracement on the weekly time frame, so it's likely to retrace to then go lower. Where? To a monthly fair value gap, which is this one right here. And how is it going to look on the weekly? On the weekly, it's going to look like a stop run, and on the daily, we're likely going to tap all of these lows. Okay? But for now, I'm bullish. Okay, short term. And that's pretty much inverse fair value gap. It's pretty much the same thing on GBP, Bitcoin. Obviously, Bitcoin is not going to be as clean as traditional markets because it's not driven in the correct way. Sometimes it's very manipulated, but it also has some sense, and you can still use it without not the same precision, but with precision enough to be profitable. And as you can see, it's the exact same thing right here. Okay, fair value gap, we're bullish, but we had a fair value gap here. Okay, lower, offer support for a while, but until it gets threaded through, now it's resistance. Same here. We had a fair value gap, we tap into the fair value gap. If we do not have any fair value gap, we can inverse it. Okay? In this case, we did have fair value gaps. Fair value gap here, we tap into it, we go lower. There's no fair value gaps here. What are we looking at then? This fair value gap. This is a fair value gap. Once there's no fair value gaps, we can look into this. Okay? And it goes lower. Okay? I think I already gave enough examples, but I'm going to show you on, so you see that it works the same on all the markets. I'm going to show you on Nasdaq. Okay, fair value gap, there's liquidity resting here that it actually never gets tapped. But there's a fair value gap here that it's actually not a fair value gap, it's a C. Okay, it's a BC. And I'm going to explain it later on, but do not worry about it right now. The point is, we trade through it, it's getting respected as bearish until it gets threaded through, we go higher. Okay, you're saying right here, okay, we're bullish, there's no fair value gaps. Where will we like price to respect? For example, let's say there was no fair value gap here. Let's say there's no fair value gaps. 0. We will use this as our fair value gap. So you see price goes lower, taps. Okay? And at this point, there's not even a point of looking for inverse fair value gaps because it's just continuing to go higher and respecting the fair value gap. So there's no point in looking for inverse places because the marketplace is on a trend. There's no points of reference over here. I'm not going to use these ones right here. Not, I'm going to use the most recent. But on marketplaces like these ones, we can use the inverse ones. As you see, I'm gonna show you. Fair value gap. Okay. We took the stops, but there's also liquidity resting here, which likely is gonna get tapped later on, which I believe it does get tapped. As you see, slightly tapped, but it does get tapped. Okay, this is a fair value gap capping the marketplace, then we go lower. Okay, then what are we supposed to do here? We're supposed to respect this fair value gap, right? we're supposed to be respecting it. Well, as you can see, the price is trying to go higher. Here it goes higher. Where we're looking at this fair value gap, taps into it, goes higher. Where are we looking here? The fair value gaps. Is there any fair value gap? Well, we could use this one. Taps into it. But also, what do we have? This one right here. Price trades through it. It touches it on this candle, which could have been an entry. Something of this nature. Obviously, I do not trade on a daily time frame. There's no point in me looking for target because I do not trade here. But on a lower time frame, you have this as your higher time frame. You understand? It goes, taps into it, goes higher. Then what do we have on the inverse? We have this one right here. We're supposed to see price supported right here, right? We're supposed to go for the highs, go for the liquidity. Well, it doesn't. It doesn't do it. Then what are we looking? We're looking for a fail. It fails. Here it fails. Again, we're starting to make lower lows. There's a fair value gap here. We tapped into it. We closed below, lower. Okay. We also had this inverse one. What are we looking at right here? We're looking at this, which I'm going to explain later on. Price taps into it, goes lower. Okay. Now, here, what are we looking at here? We have this one right here, which price is getting. But this works a different way, which I'm going to explain later on. We trade through it. Where does this candle go? It goes to this imbalance, taps into it, goes higher. Okay? But let's assume we're on this price action where there's no fair value gaps at all. What are we looking at? First of all, we're looking at this inverse one because we trade through it. Price gets supported. Once the price trades through that one, through this one, because it's getting rejected, as you can see. Now we use this one, trades through it, trades again, goes higher. Goes again, takes the stops, closes above, goes higher. There's one here, we never trade through it. And price starts respecting the current arrays because there is fair value gaps. There's one there, there's one here, there's one here, as little one, which touches right here and goes higher. And now it's not respecting anymore. Okay, so it's likely to go for this, like I mentioned. But that's pretty much all the lesson about inverse fair value gaps. So I hope you understood and enjoyed it. Okay, I decided to make the video today of CB and BC. As we already know what's a fair value gap, it's pretty much this. Intersection of the candles, 1, 2, 3, okay? But it's, as you can see, it's not really huge imbalance. It's not something huge. It's something normal. And price can trade through and completely fill it. But when we have a huge, for example, this one, huge imbalance, we do not want to see the price on a closing basis trade through 50%. On this candle right here, we're starting to doubt. We're starting to say, okay, we could start being bearish because price is not respecting. It's just going lower, and I think we're likely to go lower now. So I'm going to be cautious. It doesn't mean I need to trade it, but I'm going to be cautious on the long side and wait for more confirmation for a high probability trade. As soon as we see closing basis of the 50 and then that a fair value gap gets respected, this fair value gap gets respected and we close like this, you should not even wait for this to be broken. You don't even need to wait for this swing low to be broken. Right here, you're bearish. bearish, 100%. We're targeting liquidity. Higher time frame still bullish. Yeah, we're still bullish, but a retracement is most likely going to happen. We're likely to retrace to then go higher. Where for the liquidity? Okay. But let's take into annotation that we tapped into a weekly fair value gap. This is a weekly fair value gap, and to be more exact, it's a weekly CB. The same thing that we're looking right now. CB is for sells, sell side imbalance, buy side inefficiency, and BC is buy side imbalance, sell side inefficiency. Okay? This is a CB, and the other one was a BC. We trade through the CB, we touch it, we trade, boom, immediate rejection. Okay? On this CB, we failed, and now most likely target is this liquidity. As you can see, I'm going to explain this on the next classes, but there's also liquidity resting over here. All these swing lows, and there's a volume imbalance. Okay, something to take into annotation. Let's go into one more. I was talking about the other classes. This is 50%, it gets rejected. As soon as we see this, we start doubting. We start saying, okay, I'm kind of bullish, because at this point, if we wanted to go for lower prices, we should not just start rallying all the way up and close 50%. Okay, we shouldn't. Then the price goes, touches the top of this imbalance, of this CB, and later on goes down, touches the bottom, goes up again. Once it trades through it, we can use this as an entry for the next few days. Entry, okay. And also, we do not need to wait for this to be broken. As you can see, how many days will you be waiting if you only use this structure? Let's say you only trade structure. Let's say that's what you do. How many days would you be waiting for this swing high to be broken? Tell me. I'm not even going to count it. You go to your charts and count it. How many days? A lot. And only for you to wait all these days, and if you already knew that price shouldn't trade through 50% of this, well, you could have captured all these longs. The same thing as, let's say, price opens like I believe it's going to, and just nukes. You could have cut this short and win money on Monday. You could, but instead you're waiting for this swing low to be broken, when you already know that it's most likely to be going to get tapped. So you're going to look for shorts as soon as the market opens and it gives you on the lower time frame confirmation. You're looking for shorts. You short. Okay? No doubt. Boom. Short. Okay? What else do we have here? Let's see. More examples. Let's go to Euro. It's just I don't want to mess my charts because they're already prepared for Monday. But example right here. We trade through 50% on this candle. Boom. We go up. This fair value gap taps. We're getting accumulative sells over here. We go lower. Okay. Same thing over here. Where? Let's look. Where do we have a CB? Oh, right here. Look. 50%, boom, traded through. Boom. We're bullish. Right here we're bullish. We do not need to wait for this swing high to be broken. When does it get broken? Much later. And only for the traders that trade this to wait more days even for this. Okay. Then we go and we leave this imbalance. which hasn't been traded, and we start going higher. But as you see this, you can think, okay, this CB is getting traded for 50%, I'm going switching bullish where? For these highs. It doesn't even need to matter if you're going bullish in the sense of, for example, reversal. You do not know if this is going to happen, but you do know that most likely it's going for these highs, maybe to continue lower or actually do a reversal. And you're looking for longs all these days. Example here. This is not random. It's not just stopping at 50% for no reason. And this continues to be bearish. We trade through it and boom. You do not need to short at 50%. There's no need. But as soon as you see this, boom. Where are we looking? For value gap. Tapped into it, nuke. Go over again. Boom, nuke. Okay. What do we have here? What? This is a CB. Traded through. Am I going to wait for this swing high to be broken to look for days of bullishness? No. I'm just going to wait for lower time frame confirmation and look for buys. What else happens here? We also have a BC. As you can see, it's a really big one. 50% tries to get stopped. Whoa, we trade through it. And do we have to wait for this swing low to be broken? Not really. We can start looking for shorts because Tuesday is most likely going to nuke to it. Okay? Because we already changed the delivery and we're going lower. And that's basically it. It's not a really hard lesson, as you can see. It's pretty basic, and the explanation is 50%. You do not want to see it. As soon as it trades for 50%, you don't need to trade it, but you need to be cautious. Okay? You need to be cautious because it's likely going to trend the other way. Okay? For example, here it trades through 50% of this, okay? And we took stops. We could think, okay, we're likely to go here. But we're wrong. We're wrong here. So if you do not have any clear bias, because obviously you need to watch the weekly time frame, you need to watch if there's maybe this was a weekly fair value gap. You need to watch all the time frames. But you can just wait it out. You don't need to. But let's say you did short it, and let's say this day you lost. As soon as you see the price reclaim again, and also it's closing above this candle, which shouldn't, well, you think we're likely to go for the stops. Where were the stops? Right here, which we did actually end up doing. Once we get the stops, we can expect price to reverse. Okay. Where am I saying price is likely to reverse once we lose it? Well, once we lose this at also 50%, which you can see it's not random that the price is closing above it, well, we can assume that it's going lower. At this point, it ends up going lower, right? It ends up going lower. But it also breaks structure, so it's high probability trades that we're going lower, and it ends up going lower. So your style depends on you. I do not choose your style. If you want to be more cautious and wait for more confirmations, that's on you. If you want to be more aggressive and cut more movements, that's on you. You decide. You decide what kind you want to be, which one fits for you. You're never going to get 100% win. It's impossible. But whatever fits for your psychology and what works for you, it's the best. Okay? In my case, if I see something really clear, like this one, I will choose to trade it. If I don't see anything really clear, I will wait it out. For example, right here, it's a consolidation. Like, I'm not going to trade it because there's also I'm going to explain this in later lessons, but as you can see, Euro is making a higher high and GBP is making a lower high, which tell us, okay, this movement, as you can see, the price is pretty much the same. They're correlated assets. You can say, okay, this movement is kind of fake, so you can wait it out. You can wait for what? For this. Once it happens, you go on Friday. Any retracement in lower time frame, you short it. You do not need to get this movement. You can just wait the next day. And if you can get this movement, this is huge. This is enough. Okay? So yeah, that's pretty much everything for this lesson, and let's move to the next. Well, in today's class, we're going to be talking about inverse volume imbalances, which it's pretty much the same thing of inverse fair value gap, you know, same concept, but with a volume imbalance. So I'm just going to show it, make it quick, and move to the next topic, okay? But it's important for you to know that these work the exact same thing. This volume imbalance, of course, as you can see, it's preventing price to go higher. There's no doubt, okay? And once it gets threaded through, you can see now it's getting used as support as well with this imbalance, okay? Of course, this imbalance, but once the price displaces a lot, we do not want to see the price just stay over here for 3-5 weeks. We want to see displace these highs. So it goes lower, touches a fair value gap, touches a inverse volume imbalance, goes higher. Okay? Then we had this volume imbalance at this point. As you can see, it's used as support, as the same as this volume imbalance right here. It's used as a support. Both of them are real support. Okay? As you can see, prices actually, once it gets threaded through it, it's using it as resistance because the bodies of the candles are closing below it. Okay? There's also an imbalance which can get threaded through. There's no problem. And I will actually be looking into the imbalance. But let's say price does not want to reach the imbalance, we can use this as our area to look short. And once it trades through it, we're looking at this volume imbalance, okay? It trades through it, it never retraces through it, and it's fine. It trades through this little fair value gap. And then it goes lower. Boom. Okay? As you can see, they're pretty much the same thing. Okay? And let's go to GU to show you. GU is GBP USD. Let's see if there's any volume imbalance. Okay, right here, it gets used as real support in the price. Trades through, goes higher. Okay? Now it's used also here as real support. But price also wanted to get support here, but once it gets straight through, now it's resistance and it goes lower to the next point of discount, which is this point of discount, which is now getting used, and now this volume imbalance is getting straight through. So it will be so weird that the price touches the volume imbalance and rallies. No, it wouldn't, because we see it millions and thousands of times happen. Why would it be the opposite this time? Okay. Of course, you can get it wrong at the wrong timing, but eventually the price, once it trades through it, it will want to displace, because that's how the program, the algorithm is written. The algorithm is written in the way that it uses these levels as real support or resistance. And if the algorithm reads it as now the support okay, it's going to use it to go higher, okay? And it's the only place where we could actually see something, except that one and this inverse volume imbalance that I already taught you, right? I already taught you about inverse volume imbalance, and I already taught you about BPR, and here is a BPR. We use the BPR, we trade through the BPR, okay? We trade through the BPR, okay, perfect. Now, where are we looking? We're looking for bullishness. So if we touch the BPR, or we touch the inverse fair value gap, which would be this one, we're looking for bullishness. There's no real bearish statement over here, okay? I think that's it for this lesson. Like I said, it's a short lesson, but nevertheless, it's a really important lesson for you to understand. And if you're taking this course on a future, like let's say 2050, I recommend you to go back into your charts and see this. And maybe it's still going to be working on 2050 if they're still humans, okay? But it's something, as you can see, that it works. It works. There's no doubt about it, okay? It's no lines that are your real support resistance. Your real support resistance are these points made by the algorithm in which price reacts to it. And as you can see, it wants to get it as a support, okay? But once it fails, it's resistance. And where is it looking? The algorithm is looking for the next zone of discount or liquidity. And where is this one? It's this low. Here's the liquidity, correct? Pretty basic, nevertheless important, like I said. So let's move to the next topic. And remember, if you do not understand, keep watching the videos over and over time and get used to it. Get used to the price action, get used to the movements. I mean, you're not gonna get it in 1 week, 1 month, maybe not even in 1 year. You're going to have to put the work, okay? You're going to have to learn to be patient, to read the price. I mean, not, I suppose you know how to read, but to read the price, everything, okay? And it's not easy. It takes time, but if you put the effort, you're gonna make it. There's no doubt. There's no one that has put effort and does not make something, okay? Everyone that puts the effort, at the end of the time, he manages to get what his dream or what his goal is, okay? So keep doing it, and I'll see you in the next lesson. Well, now we're gonna watch, well, not watch, you're gonna watch what is an order block. Okay, order block, it's pretty much the last candles, 1 or 2 candles. The last candle obviously is going to be the best one, since it's going to be the most recent one. But the order block is basically the last candle or last 2-3 candles, depending on the situation, in which the price will use to accumulate and displace. Okay. If we're saying that the institutions buy whenever it's going down and they sell whenever it's going up, we're thinking that if they want to add more into these positions, they're going to be adding at the same price once it returns to this place, because they don't want their positions to be at a loss. Obviously, nobody wants to be at a loss. So, price, in this case, where do we think, let's say, we're bullish here, because we're ready to liquidity 1, 2, and 3 times. So we're ready to liquidity, and we displaced. Where are we thinking that they actually bought? In this candle, they bought. Once it went down, they bought. They were buying. Then the price naturally went up, they used to move the market, and then the price goes down again. Where? To this, to the last down candle before the expansion. There's also a fair value gap, but we have a really important place here. So it's going up now. Once the price starts going up again, where are we looking? We're looking at this candle right here and this candle right here. The price goes up again and it touches the candle again with an imbalance as well, and a BPR. We have a BPR right here, which the price used to displace higher, correct? Then we go higher again. Where are we looking? We're looking at this order block. Okay, we have a little range over here. It's fine. There's nothing wrong. And then where are we looking? We're looking at this candle and this candle. Eventually it comes over here to this candle and goes higher. Okay? If we're wanting to see price supported, what are we wanting to see? We want to see this order block hold. Okay? We want to see 50% of it hold, which it's doing pretty much all this time. But once we see this candle, we can think, okay, we're likely to go lower. And that's what they do. We go lower. Now, it's a downtrend. Where are they selling? They're selling when it's going up. It never goes there. It touches this candle right here. Look. It touches, goes down. It touches, it goes, it touches, it goes down. Ooh, what's going on? We're starting to trend upwards. That's weird, right? Like, we're starting to break upwards. And right here, whenever we have this close, I want to measure this right here. Through the 50%, we can begin to think, okay, we're bullish. If you want to wait a little bit more, you can wait for this candle. Okay? Once this candle forms, we do not need to wait for this swing high to be broken. We can start thinking it's going to eventually. So we can start looking for longs, and the next day it just goes all the way there. Then it consolidates inside a fair value gap right here. And I believe it never trades to the order block, which it's fine, but if we have a PDR rate that stands for premium or discount, we want to use it. Right. Price just goes up, okay, and goes up. And then we have this inverse fair value gap. We have this fair value gap, which use that, we go and we trend down. What are we looking at? We're looking at this order block. Price touches the order block, we touch the order block, we go down. What are we looking at right now? We're looking at this order block right here. We never trade through it, but we also have these order blocks. And we need to focus on the order blocks with the highest volume, which is the order block with the highest volume. This one right here. Right here. Price touches the order block, goes lower. Tries to, almost doesn't. Then it goes, touches the order block, and it also takes a swing high. That takes the liquidity. Most likely it's a weekly fair value gap, I would say. As you can see, it's a weekly fair value gap between this low and this low. Small weekly fair value gap, but it's a weekly. And we go down. Okay, we touch this, we go down. And order block. You do not need to short right here. You could wait for this one. Once you see the displacement, where are you looking? You're looking to short the retracement to the order block on a lower time frame. Any lower time frame confirmation of these same things, same concepts, because they all work on a lower time frame. These same concepts, you're looking for a short. Okay, we have this fair value gap. We never trade through it. But what are we looking? We're looking at this candle. Okay, we never trade through it. Where is the order block now? right here. We don't touch it, but there's a fair value gap, so that's fine. We trade again. Where's the body? Where's the body of the candle? Right here. This doesn't have much volume. So we put our order block. We touch the order block, we're at imbalance, and we go lower. Same thing happens here. We don't touch it. There's a small fair value gap, which we touch and we go lower. Where would we want to see the market stop? We would want to see the market stop here. However, it starts to trend upwards, so we can think something of this nature is going to happen. Now, if we use the same concepts that we use here, we use here, we use here, we use here, what is the most likely outcome to happen now? The most likely outcome is we're going to use this order block as an inverse order block, so it's likely to touch the order block now and continue higher. Okay? Same thing here. We go higher. What are we looking at? We're looking at this candle. Touches the order block, goes higher. What are we looking at? It doesn't touch. There we go. We touch the order block again. We go higher. What were we looking at? Well, we were looking for this imbalance that's more here to hold and the order block, and it just trades nukes. What are we looking at right now? We're looking at this order block. It touches the order block, touches the volume imbalance, touches a small fair value gap, we go lower. We break, then we touch it again, we go lower. What are we looking? We're looking for this hold. However, we don't hold, we go higher, and also we break a short-term high. Right here, we break it, we switch structure to bullish. With this instead, also the algorithm is going to sense it as bullishness. What happens? Manipulation. This was the bank crisis. March 15, 2023, Credit Suisse went bankrupt. Then we manipulate the price, we take all these stop losses, and we continue higher. Do you think someone just knew that the banking crisis was going to stop and he bought all this? Of course not. It's the algorithm manipulating, with the central banks manipulating as well. They buy all the people that's trying to short, and it goes higher. It goes the opposite high. Okay? So that's basically an order block. I already explained everything, so I think it's pretty basic. And if you have some doubts, you can just probably watch it multiple times and understand, because it's pretty basic and it's straightforward. Okay? In this class, we're going to be talking about what a propulsion block is. Okay, propulsion block is pretty much, let's say we have this liquidity resting over here. We touch it, okay, and we go up. We have this order block which gets disrespected as soon as we do this. Once we disrespect it, and we have this placement, we trade through this and tap into the order block. As soon as we see price trade through the down candle, this becomes our propulsion block, and this will be our trade. Our trade will be this, and we will be targeting these highs. This will be our first target. Well, our first target could be this one actually. And then if the market wants to displace here, because it's late session, actually there won't be any trade for me, because it's already the end of London session with New York, that is called London close. So there wouldn't be a trade for me. But if, let's say, you did trade it, because you trade any hour, that I do not recommend, well, this would have been a winner trade. However, as you can see, the volume is really low, and that's not something I really like. But in the concept, this is a propulsion block. And eventually, most likely, we will take the liquidity again, which we didn't take the liquidity again. We used the same order block. Okay? Now, Let's see more examples about what a propulsion block is. Okay, here we go. We go up, we go up, we go up, and let's say we were bearish in this case. Well, there's a little bit of consolidation here, so there's not even a chance for me to explain propulsion blocks here. Let's go to a better price action. Okay, here we go. Bearish price action. Where is our order blocks? In this case, it will be here. Never trades there. Never. Then we go lower. Then we go again. Lower. We touch an order block. Okay. Price goes through it. Through this candle. After the touch of the order block. Which will be our propulsion. It will be this candle. This up candle. Once it trades through it after touching the PD array. This is your propulsion block. You enter as soon as it touches it again with your stop loss there. And where are you targeting? You're targeting this liquidity, which eventually gets tapped and even goes lower before going higher. Okay? Let's give one last example. Okay? One last example. What do we have here? Well, we have this. We take the liquidity by a little bit. Then what do? We take the liquidity, we go down, we go up, a bit of choppiness, okay, and we go lower. So no propulsion blocks here. What do we do here? We manipulate lower. We take the stop losses. What's our bullish order block? This one, or actually this one. This will be the bullish order block because this was the down candle prior to the manipulation. Okay, 230 down candle. We touch it again. Once we see price go through it on this candle, which is our propulsion block, this one, this is our propulsion block, and we enter as soon as this candle closes above, we enter there. Boom, propulsion. Where would my stop be? Most likely it will be down here because we could see price go below this for a little bit wick and then close above, but I wouldn't want to see the price close below it. And where would I be targeting? Well, I will be targeting some kind of liquidity, which will be these highs actually. This will be my target, which eventually gets tapped and goes a little bit higher before lower. Okay, that's a propulsion block, and I hope you understood it and you enjoyed it. Let's go to the next session. Well, today we're gonna learn about what is a breaker block. Okay, what's a breaker block? A breaker block is basically when the market manipulates price to a certain place, makes a lower low, and then immediately goes the opposite way. That's the one I'm looking for when the market opens. I would like price to trade here, induce sellers, and make lower time frame entry so we can target this liquidity over here. Okay, but how does it look on lower time frame? Well, on lower time frame it's the same as the higher time frame. What will be your breaker block? In this case, this will be your breaker block. However, it gets immediately traded the opposite way, as you can see. So this breaker block was a fake. How can I determine if it's fake or not? We're gonna see that on later videos. Okay, do not worry, we're gonna see this in later videos. But something to take notice is your higher time frame. Was your higher time frame bearish? No, it was making higher lows and higher highs. Where did it go? To a fair value gap. So there's your first answer. Your first answer is, well, this breaker, is it really a breaker block? I mean, at this point it is a breaker block and it goes lower, but I haven't even mentioned what is a breaker block. I'm just trying to show you how it looks. A breaker block is in the bearish, the last down candle before the move up and the manipulation. Okay, this will be your breaker block. It goes up, it manipulates, it makes a higher high, make a higher high from this low, from this swing high, and immediately goes down. Okay, so this will be your breaker block right here. As you can see, touches, goes down. Okay, however, are we going to use this? Not really, because this was NFP, which is a pretty much no trade day. As you can see, the market didn't do much same days before and that same day, so no. But also the price already went all the way to our target, so no, we wouldn't use this as a breaker block anymore. What about this one? Where's the last down candle before the move up? Well, this one. This will be your breaker block. Once we trade through it, this was your breaker block. It goes down. But let's go to a better time frame, to a 1 hour, so we don't confuse you. Breaker block, which one would it be? Where's the last down candle? It's this one right here. Do we touch it? I believe not. We do not touch it. Price goes down without touching, it's okay. Where's the breaker block? Here. Right here we have a breaker block, okay? There's a swing low, perfect. Where's your last down candle before? Right here. This is your breaker block. As soon as price touches it, you can go short, if that's what you wish to. You could go short here, with a stop loss above here, because I believe this was NFP. So you could place your stop somewhere in between here, that it's a massive stop loss. Where will your target be? If you're in a 1 hour chart, well, your target will be this, which eventually does get hit. Once it gets hit, it retraces a little bit into where? Yeah, here was where we didn't get an entry. We take stop losses. Where's our breaker block? Here is our breaker block. Boom, we break. Where's your entry? It's right here. As soon as it breaks, there you go. Entry there. Where would your stop loss be? The swing high. Where are we targeting? We're targeting these swing lows right here, which eventually does get hit. Boom, there, right here. Here we have a breaker block as well. Price goes, makes a higher high. Where is our breaker block? Right here. This is the down candle. We could use this one as well, but I'm using this one. We trade through it, but you can wait for this and then you can short here. As you can see, 85 is the high and 84 is the low, so there you go, you enter there, goes there. Because why? Because it made a higher high and then it displays lower. Let's keep bullish examples. This is a downtrend, so it will be hard to look for bullish examples, but if we go to an uptrend, we can find them. Yeah. So basically, here we go. We're looking for up candles. So we have this up candle, in which market, as you can see, there's a lower low here. Market trades, goes low. Which was the last candle? Well, it was this one right here. Market goes, touches the breaker block, it goes up. Okay. Bearish example with this one. We have this swing low, we trade through it. Where's the down candle? Right here. Well, actually no, because we didn't have a candle closure before, so there was no trade there. Breaker block, bullish, right here. Up candle. Okay. You can use the wick and enter as soon as the wick, but it doesn't displace much, so you could try to use the body of the candle in this case. Because it's a big wick, where will your stop be? At the swing low. Where will your target be? This swing high. Remember, this is all fractal. You can do it on the 4 hour, 1 hour, 5 minute, 1 minute, whatever you want. It's the same thing. Same thing here. Okay. Let's look for more breaker blocks. Where? Bullish breaker blocks. Right here. Swing high. We make a lower low. We take the sell stops right here. And this is our entry, the up candle. Last up candle. We touch the breaker block. Boom. It's not random. We go up. Where? To this all pending liquidity. We go, and then, well, if you manage to hold your trade all the way and you weren't afraid of trade going almost all the way to your entry, you could have captured a movement all the way here at this point if you were kind of patient. Well, actually not. You wouldn't. You would have getting stopped out. And this will be another breaker block. Well, no, actually, I don't even know what kind of price action is this. It's horrendous. And where's breaker blocks? Right, can you show you the last examples? Yeah, this is December price action. It's vacation, so as you can see, it's not very nice. However, this looks pretty good. So we have a bearish breaker block right here. We make a higher high, we break here, we touch right here. But this is not a trading hour. We wait for a trading hour. We could short at Asia session. We could short right there. Asian session 20 hour. Where would our stop be? At this swing high right here. Where would my target be? This swing low right here. Eventually it does get there, and even lower. Where would our next breaker block be then? Well, our next breaker block will be right here. As you can see, we do a lower movement, we break through, no real retracement, so no entry. And I'm gonna give the last example, because I believe this is enough for you to understand what a breaker block is. Let's give a bearish one. Or bullish, if we see, whatever we see first. This wouldn't be a breaker block in my opinion, because we took liquidity and it's a range, so it's likely to go for the highs at least until we break and start making higher highs. As you can see here, it's a range as well. And I don't use breaker blocks because if it's a range, and in a range you're trying to short where the movement started, what is likely to happen? Let's say this was your break block. What happens as soon as you try to short? Immediately goes the other way. Same thing here. You try to short, immediately goes this other way. You need to understand when to use something and when not to use something, and I will teach it to you later, so no worries. Here we have our breaker block. We make a lower low, we break the swing high. You could enter here, stop loss here. I wouldn't actually take this because it seems like a downtrend and just a retracement, but this will be a breaker block, okay? But let's say this is actually a downtrend, and that way we're looking for shorts. What will we be looking for? Run of short-term highs with a displacement below. There's no entry here, but that's what you will be looking for. On an uptrend, for example this, you will be looking for entries on the breaker. For example, we take the stop, so we think, okay, manipulation has happened. Where we're waiting for a movement here. Once it breaks through it, you can enter here with your stop loss here. Where would your target be? At this swing high. Once the trade is there completed, you're out. You do not care if it goes higher. You're out. Okay, that's how you use the breaker blocks, as you can see. It's pretty simple, pretty straightforward. This is your swing low, and also it's your breaker block. It's the last candle, down candle before the move up. What it does goes touch the breaker block, stop at the swing high, and where's your target? Well, your target is pretty much at the swing low. Trade done, you're out. Or if you are swing trading, because I see here we took this stop loss, stop loss, stop loss, this place lower, you could even target all of these lows, even lower, because I believe this is a big range overall, and we're likely to go for these lows, even these lows at some point. Because remember, when we're in a range, we never know when it's going to break out. When here, we do not know if it's going to go lower. This is a range. We never know if it's going to go here until it does it. Okay. Range, whenever it breaks, well, we start looking for continuation trades. And there's other concepts that I already thought. You do not need only to use the breaker block. Okay, that's it for the breaker block, and I hope you liked it.